there's this whole balance between risk reward ratio and probability, right? So if I have a 90% chance of winning, but I can only make a 5% gain on the trade, and I've got this 95% risk factor, I'm thinking right down like a bull put spread, right? If you don't bring in enough money on a bull put spread, it turns against you. You could have to be right 20 times to make up for one time of being wrong. Mm-hmm. If you don't manage the trade and don't deal with it appropriately, right?
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have a special lesson for you. I'm putting it here on the podcast because I really believe that this is going to provide you massive, massive value. And that's what I'm trying to do here. And hey, listen, if this podcast was useful to you at all, I really highly suggest that you go check out the full trading course at aistocktradingsystem.com. That's aistocktradingsystem.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have two of my favorite guests back online, Chris Mercer and Rance Mashek, both from marketgear.com. And we're going to be talking about ratio backspreads today, something that I have experienced and I've played with, and things did not go very well. So I'm interested to learn from these guys just exactly where I went wrong. So guys, thanks for coming back on the program today.
Absolutely. Glad to be here.
So first, let's get started. What in the world is a ratio backspread and why would I care?
A ratio backspread is applied right. It is a self-repairing strategy. When I first learned about it, it was called the vacation trade because you could set it on when you go on vacation. If it works, great. And if the stock collapsed on you, it was self-repairing, right? So it sounds good. Now there is a risk factor in this, and we want to address that risk factor. And you definitely need to make sure that you're set the right way on it. And I would say that I don't really quite agree that it's a vacation trade. I do agree that it's self-repairing, but it still takes some management of the trade because there is an abyss that you can fall into if you're not careful, as we'll see here as we go through that. So,
yes. So that's where I was going to say, vacation trade, things like that. I'm like, this is not the experience I had. So
it's not, and that's the thing about, when I first heard about it, and it's like, oh, it's a self-repairing trade and we call it vacation trade. And I thought, well, I agree it's self-repairing, but there's a window that you have to watch it. And if it doesn't behave the way you want, it's important to pull the plug early on it. And if it's behaving very poorly, if the stock is behaving very, very poorly or behaving very well, the trade's great. It's when it languishes. So you want something as a driving force to hopefully make it work a little better for you. So it's something that, it's how you set up, with a lot of these, we were talking recently about straddles, and you've expressed some challenge with that. So what do you, in that one, it's like, you have to have a driving force, right? You have to have does this stock tend to move around earnings and do it before earnings, but far enough before, but while the options are still cheap, there's things about setups on these that are really, really important, and so that's something that you can't ignore in this. It's not a total freebie trade, but it is something that can be really powerful and pretty cost effective to the other place too. So.
You mentioned our conversation on straddles. That just really made me think about the whole, not Einstein, but Thomas Edison quote. He only needed to figure out one way to make a light bulb, but he found 10,000 other ways not to make a light bulb.
That's correct,
exactly right? How my trading went. I figured out one way to trade, and I found 998,000 other ways to not trade.
Well, it really is interesting, Chris, because we talk to people about, one of the great things that we have in the platform is journaling. And one of the things we look at in this is that, we tag the strategies that you're using, right? So if I'm using straddles, since we were talking about that, if I'm using straddle plays and they're not working for me, then it's the why, right? It's not that the strategy doesn't work, it's the application or how you're using it. Maybe that's the issue here. And so you look at how to structure it better. And it's one of the great things about having, paper trading, back testing, different things like that you can go and hone that, because they absolutely do work in the right use case. Same thing with ratio back spread. Same thing here. It's like, we were also talking recently about the poor man's covered call. Same thing there. If you don't place that right, you can have a stock go up and still be in a losing position because your spread between what you bought and sold wasn't enough. And you end up with, gets in a whole delta calculation, but it ends up in a situation where you can lose money. And so it's how you structure and how you set these up. So sometimes these rules, the devil's in the details, but if you play them right, they can be an absolutely great way to approach things.
Yeah.
Right? So
you've got a great point there, right? All of these strategies will make money, but you have to be in the right market condition for that strategy to work. And I think that's where my naivety earlier on in my trading was, it's like, just do this trade, or what is it? Sell a call no matter what, and it'll, 70% of the time work out, or, sell 30 delta puts and it'll always work out. No, it doesn't work that way, Rance. I know
it doesn't work that way. Right. And you know what? You might be right 70% of the time, but what happens, there's this whole balance between risk reward ratio and probability. Right. So if I have a 90% chance of winning, but I can only make a 5% gain on the trade, and I've got this 95% risk factor, I'm thinking right down and like a bull put spread, right? If you don't bring in enough money on a bull put spread, it turns against you. You could have to be right 20 times to make up for one time of being wrong if you don't manage the trade and don't deal with it appropriately, right? So, and one of the things I'd say as we get ready to go into this, is worth mentioning on any options trade, but certainly this one applies as well, is that, the old adage, nothing will turn a short-term trade into a long-term investment quicker than the stock going in the wrong direction, but the problem with options is they have a finite timeline. So if it goes in the wrong direction and you don't take the appropriate action, you don't move on it, there's a point where the time runs out and you can't make it back, right? It's going to be a loss. So it's a real important thing to make sure you apply it right.
I think that really, at least for me, was it was a real hurdle mentally to get over, because like whenever you sell an option, right, you've got, let's call it 50 days until the option expires. So in theory, if that stock's moving against you, I've got 50 days left. I can just let it work. And then, 49 and 40 come and 30 comes and you're in the money. And it's like, I still have 30 days to go. It could still work out. 10 more days go by, 20 more days go by. Next thing you know, you're $10 deep in the money. This trade that you would have made, let's call it $1, you're now out $10 on it.
Yep.
And that to me was a monster mental hurdle to get over. It does not matter how many days you have left. What matters is the price action right now. If your price action no longer confirms the trade style that you put on, you must make the change.
I'm going to say that again because it's worth repeating. If you set up a trade expecting a certain behavior of the stock and the stock breaks that behavior, get out, right?
Yeah.
I mean, that's another way to put it, right? You have an expectation. And, one of the things that, we did bull put spreads, I was talking about putting it on below support. If it breaks that support, don't think you have a chance of it coming back. Just cut your losses and move on. Right. This one here we're about to show is the thing you really want to watch out for is stalling, right? If it's going up, great. If it flips and drops, great. The problem is when it stalls out. And by the way, that's actually in a way a little harder, right? Because, it didn't really go down, it didn't really break direction exactly. It just paused. Well, that pause can hurt you in this particular trade. So, it's a real important thing that, you set the trade up right and manage it appropriately. One of the things that we look at, in our journaling, we track win-loss ratios, both by dollar and percent. And one of the things that I tell people all the time is, look, if your dollar win-loss ratio looks worse than your percent win-loss ratio, it means you're losing more money. Like you're winning 60% of the times, but you're losing money, a huge amount more of the times, right? So that was a beautiful, eloquent way to put that. But the point being that if you
it happens
lose it,
very rarely, trust me.
if you don't watch that, what happens? It's an indication that people were holding on to their losses too long, and cutting with options, making the either adjustment to the trade, because adjusting is definitely, if there's a shift in it, adjusting can definitely be a way to go, or just cutting losses and getting out makes it a lot more effective. You don't have the opportunity to, I could hold on to this for the next 10 years for it to come back. And that's not the case in an option. It's going to be gone in a few weeks.
And especially on an option you sell, there's that mental aspect of, it's still out of the money. Why would I want to close it even though it's working against me? Well, it's because every day it's going to potentially continue on this path, right?
Yep.
The other thing it does, by the way, is it usually distracts you from something else you could be doing that maybe if one thing doesn't work out and isn't doing what it's supposed to, but you're going to spend the next 38 days staring at it and hoping that it does. What could you have done with your time and your capital in those 38 days instead on a trade that now I see another setup, and maybe that's the one that's going to work instead of the one that clearly isn't.
Yeah, well, that's well said. Yep. Okay, so let's get into this. So show me how to set up a ratio backspread, and let's kind of talk through the mechanics of what this is.
Sure. All right. So as we do this, just want to make mention, of course, my standard thing here is I'm going to share with you some real numbers off a real market. And these are educational examples, not trading advice at all. Not a solicitation for any particular trade. So here's here's what the ratio backspread is. There we go. Here's what the ratio backspread is. You're going to buy at the money calls. In fact, for our discussion here, we're going to buy 2 at the money calls for every 1 in the money call that we sell. And the deal is you don't want to pay for this trade. You want this trade to be free or a credit when you get into the trade. So what do I mean by that? Let's take a look at some real numbers here and see how this plays out. So first of all, this is the Market Gear platform. And what we're going to do is go in and look at a couple of stocks here. And 2 of them that I was looking at today a little bit on this was Pfizer and Apple. And if we look at let's go with Apple first here. And in Apple, if you notice here what we have, Apple's on a bit of a run right now. Now, I realize that there are some resistant points up here and that, but it's was stagnating for a while, started to take off a bit here. And so let's take a look at what we might be able to do to make that happen. So to do that, what I'm going to do here is go over to the options page. I'll grab this. And my position here I want to do is I'm going to go out. Now, here's an interesting thing about this, and this is one of those where you got to watch how you set things up. I want to go out as far as I can, practically speaking, to have more time to be right. But there is a factor here that does come into play, and that factor is that you're going to be selling 2 options to buy 1 option. I'm sorry, my mistake. I'm sorry. Selling 1 option to buy 2 options. Right. Selling 1 option to buy 2 options. So one has to bring in enough money to pay for the other 2. So the further out in time I have, because I'm dealing with time on both these options, it becomes more difficult to do. My kind of limit on this is I want to be probably at least 45 days out. Now I'll stretch that a little bit, but I don't want to certainly be 30 days out. I just don't think that's enough time for this to work well. So let's take a look at this. So if I take this here, we're at 45 days out, and right now Apple at 133. So what I'm going to do is I'm going to go buy the 133 option. I'm going to actually get 2 of those. And then what I want to do is I want to pay for that. Right. So now these are 570. So how am I going to pay for it? I need to bring in, at least, because I did it twice, right? So I have to bring in at least 1140 to make it work, right? So then when I go down here and where can I get 1140? Well, right here, that gives me a $10 spread, by the way, 133, go down to 123, and I'm bringing in 1190. Right. So if I do that, so I'll sell that. And here's what I have. This is my risk graph over here on the right-hand side. What happens is as the stock goes up, you've got two options making you money in this trade. And you have one option that's going to be losing you money, right? As the stock goes up, because you sold that one. Because you have these two making you money and only one losing you money, you end up profitable in the stock if the stock takes off or continues, in this particular case, continues on its upward ride. If, however, now, by the way, when you did this trade, if you look at this, this is a $50 credit to do this trade, right? So I put $50 cash in my account. And by the way, one of the things that people have to wrap their head around a little bit here is normally people think about a credit trade as you bring in the money. You're not really making money on the movement. You're making money on the time decay. Right. So that works for a covered call. That works for, bull puts, pretty much credit trade. But because of the nature of this, what I'm really doing, if you think about it from this perspective, I'm buying a call option, but I'm doing this other thing to pay for it. Right. Yeah. Which is selling, buying one, selling one. Right.
I mean, you could almost see it there on the screen. I can't show my mouse, but on the left-hand side, you've basically got a call vertical spread.
Yep, right.
And then instead of that leveling out on the backside, it turns back up and goes upward.
Right. In fact, actually, one of the cool things about this is the ability to kind of compare things. Exactly. Right. So you've got this trade, but what I did was, instead of taking this money and putting it in my pocket, I'm using that money and reinvesting it into being able to buy another call option for free. Right. So if you look at this trade is 620 credit. Well, my option here is only 570. So I'm going to take 570 of that 620. By the way, the difference 50 cents. That's why it's $50 credit in the trade. By doing that, I put myself in a situation where now I'm making money on the upward move. Right?
So would you consider this to be a bullish trade or a bearish trade or neutral?
A bullish trade that I'm not confident in. How's that? How's that for an answer, right? So if it continues going up, I'm going to make money on the upward movement, right? And again, for people not familiar, this is the stock price here. As the stock goes up or down, what happens to the trade? So if the stock goes up, I'm profiting because I've got that one basically free and clear option, that 133 option that's making my money on the way up. Then you have the other side of this, which is that bear call position credit that you took in, right? Where you have that risk factor. So if the stock were to collapse, basically anything below 123, in this case, the whole thing ends up expiring, worthless because it's all out of the money. And I kept the credit at 50 cents. Or $50 for the total trade. So it's a trade that if it goes down, so I'm not looking to make money. I'm not looking to make 50 cents. I'm looking to make money on the upward climb. But if it turns, I have that extra, that benefit. So the risk factor is in this area between those 2 points, right? And so this is where we get into managing it. And I'd like to hear from you. What was your experience?
I would call that valley right there, the valley of doom or the valley of death or something like that, because that's where I ended up. All right. So this is the first time I blew up my account. I've done it twice. The first time I did it was here. It was election night, 2016. Going into the election, I loaded up like everything in ratio backspreads, exactly like this trade. I couldn't tell you the details, but it was set up almost similar to this. And I was telling my wife, I thought it was a genius, right? That's usually the first sign of trouble. Right? I was like, hey, it doesn't matter what happens tomorrow. If Trump wins or if Trump loses, we're going to make money either way, if the market goes up or if it goes down. Now, if you remember that night, the market was lock limit down. And I heard so many stories of people, maybe I forget who it was, but it was some giant trader like George Soros or somebody like that went out and bought everything they could that night. They were like, this is the biggest discount ever. Trump is good for business. We're going to load up as big as possible while it's down. And then the next morning and throughout the rest of basically the presidency he had, stocks went nearly vertical. And where I went so wrong was election night was on Tuesday, as usual. Put my trades to expire on Friday. Huge red flag. And when the market looked like it was going to open down, I was like, no problem. We're good to go. But then when it started going up, I'm like, oh, this is great. I'm going to give it some time to work. By the time Friday came along, my call strikes were in the money like this, but it had not reached its break-even point.
Mm-hmm.
And so it expired worthless. And I'm like, how did this happen? I mean, I remember Wednesday morning waking up and seeing a giant profit in my account, giant paper profit, because it had made that quick up move. But then I let it with the idea that, hey, it'd continue on. And then it just kept dragging and dragging and dragging down into that valley of death, valley of doom and despair. And then my account was gone. And I'm like, son of a bee, I can't believe that this is how it went down this way. I was totally right, but I totally blew the trade.
Yep. So there are two things that you did in that trade that I would share from my experience in this is not how I would approach, right? So I don't want to say it was wrong, except for the trade didn't work out for you at that particular case. But two things about this: you did it right before the election, like right before, right? So one of the challenges with right before was where, and I don't know what the instrument was, all that stuff. But one of the things you want to watch is you don't want to do this in moments of really high implied volatility.
Okay.
Because if you're doing that, it's kind of like the straddle play we talked about a few weeks ago. If I buy when options are expensive, now it has to move enough to overcome the not only the cost of that trade, but the fact that once earnings comes out, volatility is going to drop, right? So the thing about the straddle on earnings, you want to make sure that you have that driving force to move it, and but you don't want to have the expensive options in place. So what do? You do it far enough beforehand. The other thing, so in this particular case, like one of the things that I look here, if I look at the implied volatility chart right here, I can see here, if I just clean this up, so I'm only looking at implied, right? So the yellow line is the average implied volatility. And we look right now at where it's at, we're at 31 and the average is 38. Right. So right now we're at a relatively low implied volatility for Apple. So if you see where we're at here, let me just show you what happens, because I think you brought up a really good point. If I go into this and now the event happens. So here's what happens is, you have this anticipation. I don't care whether it's an election or an earnings, whatever, you have this anticipation. There's this pent up, anxiety, whatever, fear, whatever, this implied volatility. Once it's a known result, Trump won the election in 16, right? So once it's a known result, implied volatility starts to fall out of this. Now you could still have move, but implied volatility, the fear factor, the unknown of that drops out. So if you look at this here, this is let's look at the dotted line here that I'm pointing to, because the dotted line is the trade as we entered it today. And watch what happens if I drop implied volatility, right? So if implied volatility drops down, you end up in that loss. Now, the other thing is you did this with 4 days to go. Right. And
like I said, Rance, I found out all the ways to not trade profitably.
Well,
this is just one of them.
The thing is, it doesn't necessarily mean the strategy was wrong. It just means the application of the strategy wasn't the ideal way to go. Right. So that's part of what, that's part of what we're here for. Right. That's part of what I want to share these with you. Because and by the way, the other side of this is if implied volatility is low and now it goes up, the whole thing, look at, if you look at that line again, let me go back down to where it is today. And if it just goes up to its average implied volatility, the whole line elongates. If it even gets better than that volatility, the whole thing works. So it can actually work really nicely for you in that particular case. But the other one you have to watch for is it dropping down in time, right? So as you go down, so the only way you can lose all your money in this trade is if what you do is go into this where you have where the stock is at this strike price, right? So it's a strike price that you purchase. So in this case, the 133. If the stock is at 133 on expiration day, you're hosed. That's a technical market term, being host, right? So it's like, that it just sucks the money out of your account, right? So that's the time that you can lose money. So what I'm going to do is I'm going to be playing this out. I said 6 weeks, right? I that's where I want to be. And why? Because I have time to rate. And if it stalls, I can withstand a few days of stall But if it stalls when it's inside this area here, you don't want to stay in this trade. You want to get out.
Right.
And so, again, if it's in that nice upward trend, if I go over here and look at the stock for just a moment, it's in this. I mean, this thing is gone in a matter of a couple weeks here. We've seen it go up $15, greater than 10%, in that. In that period of time, and it's cleared out some resistance levels and that now moving up. So, think that's the case, but if it were like to come up, hit and fall back down, now you're in that situation where you're in that self-repair. So how you apply this is real important. My risk today, as you can see here, relatively minimal, the dotted line. As it goes toward halfway to expiration, I still have minimized risk compared to where it is on expiration day. So if it isn't trending nicely, doing what it's supposed to do, continuing this upward move, I'm out.
So
Right?
why, in this case, would we want to make the ratio backspread instead of just buying the long call, same strike? If we want it to be bullish, what's our advantage of doing this?
If you're bullish and you feel like the stock is just going to go up and you have total confidence in that, I'm going to tell you that buying the call is going to play out better than a ratio backspread if it absolutely does go up. But if it goes down, so what's the difference in this? If I were to look at this trade from a standpoint of a long call position, what am I looking at in a long call? I'm looking at a trade that looks kind of like, well, that was beautiful straight lines, right? But
well done. Yeah, well done there.
That was really well done. Yep. I think there's actually a line thing here. Yeah, there you go. So I'll do it this way. I'll make it look a little better. So
I think there's a way you could actually compare two trades. But anyway.
Well, there is, but for the sake of speed here, I was going to share this real quick. But there is, absolutely. That's kind of cool. But the upward, so I have this upward movement here if it, on the call. But then anywhere below this, now I have my risk, right? So if in this particular case, if the stock starts to fall, everywhere through this whole thing, I've got risk. In this one, in the call ratio backspread, I have risk in a window, but then it's that self-repair.
So that's the vacation part of it, right?
Right. That's the vacation part. The problem with that vacation, so it's self-repairing if it goes the wrong way on you. And, I'll tell you what, I've really liked playing this trade when you have stocks that are on a tear, right? They're just like, they're just taking off. And, you look at now, the challenge with it is, again, you got to watch your timeline, because if there's too much implied volatility, it's hard to get that 1-to-2 ratio. Now, by the way, you can also do a 2-by-3 ratio, but let's not get into that in this call at this time today, because you really need to stay with the idea of I'm gonna buy two. I'm going to pay for those two with the one I'm selling, and by setting that up, if it goes the wrong way on you, you don't lose money in the trade. So follow what I said. If it goes the wrong way on you, you don't lose money in the trade. If it goes the right way on you, you're profitable in the trade. If it doesn't move, if it stalls, that's where your risk is, right? And that's the area you want to really watch out for. And so that's why I want to make sure I have enough time to clearly watch it continue its trend. If it stalls out, be able to still get out of this with a minimized risk in the trade. So we're showing this one on, I'm showing this one here on,
but one other thing I was going to say there is, by the way, Chris, so there is the other difference is that when you just buy the call, you are using money in your account, right? You have to actually use money in the account. Whereas with this trade, what's the cost of the trade to begin with?
It's $50 in your account when you do it. Now, right. There's some margin. There is some margin, right? Sure. The margin is the spread minus the credit, but it's not like you're tying up the whole thing for that. So it's how you balance it and work through that. But yeah, you're right. It doesn't cost you to do the trade, right? It's putting money in your pocket when you do that. And there was one, so I was looking at this one, and the other one I thought was interesting. I just want to make mention of just as one more quick example on this is Pfizer. So you look at what's going on with Pfizer right now. And of course, there's a couple things happening right now. One of which is, of the, Johnson and Johnson's, they're calling for a pause on using the J&J vaccine here in the U.S. They've already paused elsewhere. Pfizer is showing to be one of the better of these, that Moderna, but Pfizer is showing really good results on the variants of the virus too. And so if you look at this, we have a nice upward movement here. And the thing about this one I thought was real interesting when I was looking at this, I was initially going out my 45 days, and I went, let me go out and look at June. And I did this. This was kind of interesting. If I go out and do June, and I buy the 37, the at the money. So right now it's at 36.95. So I buy the 37, and I can pay for that by literally just by the 35. So it's only a $2 spread in this. Now, mind you, there's a little bit of a bid-ask spread going on here. In fact, it's a little wide because it wasn't this wide earlier today. Right now it's 30 cents on the 35s. But if you look around it, there's 20 cents. This is 4 cents. So I would think that trade's going to come to us a little bit and be a credit again. It was a credit earlier today, probably that where again. But now I've only got a $2 spread. Right. So my window is pretty narrow, and I still have that whole upward movement, and I got over 2 months for this to continue to do that. Right. So if it stalls out, so I'm looking at the chart, it's taken off here, and let's just go, it hits this point up here and it hits this resistance and just stops. Well, I still have 2 months. I'm not saying hang on for 2 months. I'm saying that because I have 2 months, if it does stall, I'm still only going to be in the very first part of that time decay. And so if it stalls, cut my losses, and I'm not going to see much of a loss in the position. Right. And so it's a much better way to be able to play. And again, what I was looking for was, what's a driving force, something that's on a move. Well, I think that's with what's going on right now with Pfizer, there's some opportunity there. We're seeing it on a move. We've got some negative news on a competitive vaccine that could help here, some positive news on how they're doing on the variants. And so I'm looking at this going as an opportunity here to be able to take advantage of that. So that's what I'm looking at on Pfizer. It's the 35, 37, selling one of the 35s, buying two of the 37s, and getting in this. Now, mind you, right this second, it's not actually, you know what? I told you it would shift. In that little bit of time, it did shift. Now it's in a credit again. You can see it above the line here. That's how I can know that. We dropped down in our, so now we're only at a 12-cent spread instead of a 20-cent spread there. So I made that difference, right? So that, that timing to get in, now it's a credit trade. I'm only in a $2 spread. So my window is fairly narrow. Actually my total risk is also relatively low for it. On a single lot trade, it's under $200 of risk in the trade. And if it takes off, I have that upside to be able to go.
Well, Rance, I got to tell you, we covered a lot in this. So this would be, I wouldn't call it a vacation trade. No, I wouldn't call it a vacation trade. Would never put any trade on as a vacation trade, because really, if you're talking money here, you need to be aware of your money. I think the best vacation trade is cash. That's just my opinion.
Yep.
But this is a really interesting strategy. I've had my run at it, and I've lost a good amount of money learning how to not do it. But if you were paying attention, I think Rance showed you the right way to do it and talked about the right way to do it. And this could be a great option, pun intended, to add to any portfolio going forward.
So just a really fast recap, make sure that your implied volatility is not too high. Give yourself enough time for it to move through and be right. And if it stalls and it's anywhere in that area, that abyss that it could fall into there, get out. Don't ride that through anywhere close to expiration.
Absolutely. Yep. And if you found this useful and you think that this platform that Rance is using is pretty cool, because I got to tell you, every time that they pull it up, I think it's pretty cool. Head on over to marketgear.com/Chris Uhl. That's me, CHRISUHL. You'll get 2 weeks free of Market Gear to test it out for yourself, and then 50% off your first month. And this links to all kinds of brokerage platforms. So no matter where you're at, there's a good chance that Market Gear is going to work for you. So guys, thank you so much for coming on today and talking about ratio backspreads. I learned a lot, and it certainly was painful to go through that again, especially with you pointing out everything I did wrong. But you know what? That's how we learn. It sucks, but sometimes that's how we learn. I
bet you didn't trade for 2020 election.
No, actually, I didn't. No.
See, so you already had learned. You're fine.
Yeah,
it's all good.
I gotta tell you that was really brutal. I mean, like I said, the first time I blew up my account was right there, and I knew exactly what I did wrong by that Friday. I was like, son of a bee. It didn't go the right way. But I hope it goes the right way for you for watching today's episode. Make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks I upload every single week to help you trade faster and trade smarter. And I'll see you on the next episode. Okay, so what'd you think? That was pretty incredible, right? Now, if you liked that, that's only a taste, only a sample of what you're going to find in the full AI stock trading system. And I really highly encourage you to go and check this out. Obviously, you are interested in learning on how to trade, and that's why you're listening to this podcast. Now, I'm going to take and download my entire trading system that I use day in and day out onto you. And the only way I'm going to be able to do that is over at the AIStockTradingSystem.com. You're going to get phase 1, 2, and 3, several bonuses, and on top of that, I'm going to walk you through over a dozen trades that I put on inside of my account, holding your hand and showing you exactly how I got in, how I got out, how I use the artificial intelligence data, and how this could work inside of your own trading portfolio on a daily basis. So make sure you head on over to AIStockTradingSystem.com. That's AIStockTradingSystem.com to learn more and to get started and to download my decade plus worth of trading experience into your hands so you can start using the AI stock trading system today, the 5-step system to take the guesswork out of trading. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.